Welcome back to The Exchange. Some of Wall Street's biggest names are in a heated race to bring private credit to the public, with the likes of BlackRock, State Street, and Apollo all launching similar ETFs and products, giving retail investors the chance to access this $1.7 trillion market. Those proposed ETFs still have to clear regulatory hurdles, and questions remain about risks and liquidity. Joining me now to try to answer some of them, Anna Arsov is Global Head of Private Credit and Financial Institutions at Moody's. Anna, it's great to have you here.
Great to be back.
Welcome back. So this has been a hot space for years now. It's gotten to be about the size of private equity, really, but a lot of people still don't know what it is. What is it exactly?
So private credit really originated with the direct lending market, and that's really provisioning credit to leverage sponsor finance companies. So we estimate that out of the 1.7 trillion, around 800 billion is direct lending. And really what made that market so attractive was after COVID, the leverage finance market was really closed for a couple of years. So it really created a boom of providing alternative source of financing and the bank-owned a leverage finance market. And that now is quite commoditized, so they're looking for new areas of growth.
Good point. I mean, also we should kind of say very plainly, one reason investors have loved private credit is its very high returns. So when you can get, these are effectively bank loans and similar kinds of
Correct.
products. You know, when you can get 7, 8, 9%, and then when the Fed starts hiking rates and those go even higher, their floating rate a lot of the times, people feel like it's a gold mine. What might they be missing? What are some of the possible risks, especially for retail investors who might now start to enter the space?
Look, this is a highly leveraged space. You're financing, leveraged companies anywhere between 5 to 7 times EBITDA. This is why these companies are not financed by the banks, because that would be penalizing from a capital perspective and risk management perspective for the regulated banks. So this alternative providers of capital found a niche of how can we finance the, $3 trillion of private equity dry powder elsewhere. So this was one source, obviously, of funding. But now that the leverage finance market is opened, what happens is that the spreads and differential of, if you will, profitability of this market relative to the broadly syndicated loan market has squeezed. So what are the new areas of growth? One of them that we've heard is looking into partnerships with banks of how we can commoditize every asset class out there and put it in the private credit to the asset-backed securitization market. So that was one of the announcements that we heard over the last few weeks with Apollo, for example, and a French bank, BNP Paribas. And now the next one, which I know we're going to go into, is retailization.
Right. So there's already a bank loan ETF. Is private credit offering something much more tantalizing? Certainly different kinds of structures. You mentioned ABS are in there. But, I mean, fundamentally, if people wanted access to this, could they get a version of it already? Or are bank loans just a different kind of animal?
No, unfortunately, that does not really exist today for the retail market. So this is one way to get basically along on a private credit ABS, which per Apollo is going to be a very significant strategy of growth as the banks are eliminating some assets from their balance sheets, so trying to be more capital efficient. This is one way that private credit market will be able to, if you will, originate from the banks, but then put it in various structures. So this is why this is a unique way to do it, but however, it comes with some risks.
Do you know from the performance of private credit, which is maybe a decade-old asset class, not been through a lot of different testing opportunities, but what the actual take-home yield of some of these investments is? So in other words, if we have a downturn, if we have another inflation spike, if we have an upward move in rates that puts pressure on them, maybe the investor buys it thinking they're going to get 9%, they actually get 5%. I mean, do we have any kind of data so far to tell us what the real returns are and not just kind of the advertised yield?
Look, it's very hard, as you said, to portray that in because this is the asset class that grew with the rising interest rate. Where are we going to be with another 100 basis points cut? But it has been a 100 to 200 basis points spread relative to other investment grade assets. Because one thing that it should be very clear around this ETF proposal, and again, it's in a proposal stage with the SEC. We don't know if it's going to be approved. It's going to take probably a prolonged period of time than a normal ETF approval because of its illiquidity of the underlying asset class. So that will take some time to basically lend, if you will, both with the regulators and ultimately with the retail investors. But one thing of warning is that there is a liquidity mismatch. At the end of the day, this is supposed to have everyday liquidity for an asset class that it was created for example, insurance companies and pension funds who can keep it longer on balance sheet.
True. There are many different companies for individual investors. I mean, they're going to want to look through and say, what are the fees on each product? What exactly are they? They're all going to, of course, be slightly different. From a macro point of view, a lot of people think the private credit has been a good thing. It gives banks a place to the banking system a place to go when there's a need for capital, and traditional banks can't handle that. But does it also hide maybe risks developing within the financial system that are kind of outside of the regulatory purview?
Look, I think this is a very important questions that all regulators are looking into, including ourselves, as monitoring the market risks, if you will. We've hence undertaken various studies of for example, the regulated industries like the insurance industry or the banking industry exposure to private credit. And so far, what we will publish, actually research next week, will show that around $500 billion of aggregate exposures among 30 largest banks in the world. So that's kind of less than 3% or about 3% of total assets. So it's not significant, but if it continues growing, it's really important to provide more transparency of these risks.
That's absolutely right. Anna, thank you for walking us through all of this. We'll see what comes to market. Anna Arsov joining us from Moody's.